Welcome to CryptoHub, your authoritative source for measured, fact-based reporting and analysis on developments across blockchain technology, digital currencies, and the interconnected global financial ecosystem. In this detailed examination, we will dissect the precise mechanics of Bitcoin's latest price action, identify the concrete catalysts that have accelerated the move lower, evaluate the technical implications of the broken supports, assess secondary effects rippling through Ethereum, altcoins, and derivatives markets, place the episode in appropriate historical context, and outline the range of plausible near-term and medium-term scenarios that informed observers are now contemplating. Our objective remains the delivery of clear, dispassionate insight that enables listeners to form their own conclusions based on observable data rather than sentiment alone. Bitcoin's price trajectory over the past several weeks has been characterized by persistent and accelerating downside pressure that culminated in a clear violation of the $63,000 region, a level many market technicians had flagged as a critical inflection point because it coincided with prior consolidation zones, key moving average convergences, and clusters of historical buyer activity. Closing prints around $62,630 on the most recent session reflect not only a breach of that threshold, but also a continuation of the larger corrective phase that has already erased more than half the value from the cycle peak, near $126,200 recorded earlier in the year. The speed of the most recent leg lower has been notable even by the standards of an asset class accustomed to volatility. The token shed roughly $18,000 over a 10-day stretch, equating to a 23% drawdown from the $79,000 area that had acted as a near-term ceiling only weeks earlier. Such magnitude of decline in a compressed timeframe naturally invites scrutiny of both the fundamental drivers and the technical feedback loops that can amplify moves once important levels give way. Technically speaking, the concept of support refers to a price band where demand has historically proven sufficiently robust to absorb selling and arrest further declines, often because it aligns with previous swing lows, round number psychological barriers, or the convergence of widely followed indicators such as the 50-day or 200-day simple moving averages. When price slices through these zones with conviction and expanding volume, it frequently signals that the balance of power has tilted towards sellers, at least in the short run, and can prompt algorithmic systems, stop-loss orders, and discretionary traders to liquidate or reduce exposure. In the present case, the breach below $63,000 carried additional weight because it followed an earlier test and temporary hold near $62,700, a level some analysts had described as a structural line in the sand, whose loss would invalidate elements of the bullish market architecture that had persisted through much of the prior advance. Once that floor gave way, attention immediately shifted to the next cluster of potential demand around the $60,000 psychological handle and deeper zones near $58,000 to $55,000 that had served as important reference points during earlier corrective episodes. Market depth data and order book snapshots indicated thinning bids beneath current levels, raising the possibility that any further impulsive selling could encounter relatively light resistance until those lower areas are reached. The catalysts behind the accelerated selling are multifaceted and interconnected, spanning macroeconomic developments, flows within regulated investment vehicles, corporate treasury activity, and the mechanical effects of leverage within the derivatives complex. Geopolitical frictions, particularly tensions involving the United States and Iran, have contributed to an uptick in inflation expectations and a corresponding reassessment of the likely timing and extent of Federal Reserve policy easing. When risk assets such as equities and cryptocurrencies encounter an environment in which the path of least resistance for interest rates appears higher for longer, the discount rate applied to future cash flows or speculative growth narratives rises, exerting downward pressure on valuations. This macro overlay has coincided with a sustained period of outflows from spot Bitcoin exchange-traded products, with reports indicating multiple consecutive sessions and even a streak extending to 12 days of net redemptions that have cumulatively removed several $1 billion from the vehicles that had previously served as a major source of structural demand. Institutional channels that once absorbed supply are now contributing to it, creating a feedback loop in which visible selling begets further caution among other large participants. Compounding these pressures has been activity in the futures and perpetual swap markets, where elevated leverage had left a substantial overhang of long positions vulnerable to cascade liquidations once price began to slip. Over the most recent 5-day window, forced unwinds reportedly exceeded $5.5 billion, a figure that illustrates how mechanical deleveraging can transform an orderly correction into a disorderly flush. When funding rates turn sharply negative and open interest collapses in tandem with price, it often marks a capitulation phase that clears weak hands but can also overshoot on the downside before equilibrium is restored. Corporate treasury flows have added another layer of complexity. While certain large holders have historically been net accumulators, market chatter and observable on-chain movements have included periods of distribution or reduced buying intensity that, even if modest in absolute terms, can exert outsized influence on sentiment when they occur against a backdrop of already fragile confidence. The reaction across the remainder of the digital asset complex has been consistent with historical patterns in which Bitcoin's dominance temporarily rises during risk-off episodes even as absolute prices fall. Ethereum and major altcoins have registered larger percentage declines, with some names shedding 14 to 20% in the same window that Bitcoin moved lower by roughly half that amount. Total crypto market capitalization has contracted meaningfully, and the Bitcoin dominance metric has hovered near or dipped below the 58% region, prompting commentary about potential rotation opportunities once the immediate deleveraging subsides. Stablecoin issuance and exchange reserves have shown mixed signals, with some evidence of capital exiting the ecosystem entirely rather than simply rotating internally, which tends to confirm that the current episode carries a genuine risk-off character rather than a purely intra-crypto reallocation. Placing the move in broader historical context reveals that corrections of 30 to 50% are not anomalous within Bitcoin's multi-year cycles. The 2022 bear market featured far deeper drawdowns, while the 2024 to 2025 advance included several 20+% pullbacks that ultimately proved to be healthy consolidations rather than cycle-ending events. What distinguishes the present situation is the combination of institutional infrastructure now in place, including spot ETFs and corporate balance sheet exposure, alongside the still elevated leverage that can produce violent but often short-lived liquidations. Some market participants are therefore framing the breach of support not as the beginning of a new bear market, but as a necessary reset that flushes excess speculation and potentially sets the stage for a more durable advance later in the year or into 2027, provided macro conditions stabilize and ETF flows eventually turn positive again. Others, however, point to the speed and depth of the recent slide, the persistence of geopolitical uncertainty, and the possibility that further ETF outflows or corporate selling could pressure price toward the $50,000 to $55,000 zone before a sustainable bottom is established. Analyst and institutional commentary has reflected this divergence of views. Certain research desks at global banks have characterized the current levels as offering attractive entry points for long-term dollar-cost averaging, citing the structural bid that remains from ETF holders who have not yet capitulated en masse, and the historical tendency for Bitcoin to recover strongly once leverage is reset. Other voices have adopted a more cautious stance, highlighting the risk that a decisive break of the $60,000 region could open the door to a test of the 2024 lows or even deeper retracements if macro headwinds intensify. Prediction markets and options pricing have begun to assign non-trivial probabilities to sub-$50,000 prints within the coming months, although such instruments also embed the possibility of sharp rebounds should positive catalysts emerge. On-chain metrics such as exchange inflows, realized price distributions, and the behavior of long-term holder cohorts will be closely monitored in the days ahead for signs of either continued distribution or the first indications of accumulation by patient capital. For market participants, the immediate priority centers on risk management rather than directional conviction. Position sizing that accounts for the possibility of additional volatility, the placement of protective orders or hedges where appropriate, and a clear distinction between capital allocated to high-conviction long-term holdings versus shorter-term tactical exposure have all become more salient. The episode also underscores the importance of monitoring not only price, but also the health of the derivatives market. the trajectory of ETF flows, and the evolution of macro variables that influence the broader risk appetite. While digital assets have matured considerably, they remain sensitive to liquidity conditions and narrative shifts, and periods of deleveraging can produce overshoots that later appear excessive in hindsight. Looking forward, several scenarios merit consideration. In a constructive resolution, price could stabilize near current or slightly lower levels, form a base through a period of consolidation, and eventually reclaim the broken $63,000 to $65,000 zone on improving sentiment or renewed institutional inflows. Such an outcome would align with the view that the recent move represents a healthy correction within a larger secular uptrend supported by adoption curves and supply dynamics. A more adverse path would involve a failure to hold the $60,000 area, potentially accelerating liquidations and driving price toward the mid-50,000s or lower before capitulation exhausts selling pressure. Between these poles lies a range of choppy, range-bound action in which neither bulls nor bears achieve decisive control until clearer macro or flow signals emerge. The coming weeks will likely be defined by the interplay between these forces, with each data release on ETF subscriptions, geopolitical headlines, and Federal Reserve communications capable of shifting the balance. Throughout this period of elevated uncertainty, the value of disciplined analysis and avoidance of emotional decision-making cannot be overstated. Markets frequently test the resolve of participants precisely at moments when fear appears most justified, and history contains numerous examples of sharp recoveries that followed periods of intense pessimism. At the same time, respect for price action and the information it conveys remains essential. Broken supports do not automatically reverse simply because they have been breached. An additional confirmation of demand re-entering the market will be required before a sustainable turnaround can be declared with confidence. As we conclude this comprehensive review of Bitcoin's breach of key technical supports and the accompanying rise in market apprehension, it is evident that the digital asset sector is navigating a consequential juncture shaped by both endogenous leverage dynamics and exogenous macro variables. The situation continues to evolve rapidly, and developments over the next several sessions could materially alter the near-term trajectory. For ongoing coverage of these and other critical developments in the cryptocurrency space, including technical updates, on-chain insights, and macro context, we invite you to remain engaged with CryptoHub. Our commitment is to provide the clarity and depth required to navigate these markets thoughtfully. Thank you for your attention to this analysis, and we look forward to sharing the next installment with you soon. This has been CryptoHub.